Major funding for this program has been provided by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP. Additional funding has been provided by grants from AVR Realty Company, LLC, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, Cushman & Wakefield, Dime Savings Bank of Williamsburg, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Stephen Napolitano, First American Title Insurance Company, Friedman, LLP, Gemini Real Estate Advisors, LLC, Genova, Burns and Gian Tomasi, Grubb and Ellis, Investors Savings Bank, Jack Joffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Markham, LLP, Marcus and Millichap Real Estate Investment Services, Margolin Weiner and Evans, LLP, Massey Knackle Realty Services, M&T Bank, Meridian Capital Group, The Moynihan Group, Newmark Knight Frank, Orphanides and Associates, Siami Development, Inc., SJP Properties, Sterling and Sterling, Inc., RAL Companies and Affiliates, LLC, Spandrel Property Services, Urban American.
So here we are. It's the fall of 2010, and I hear there's so much money out there for real estate. So I brought the bankers, the guys who have the bucks, who are going to say, and they're going to say, oh, show me where the money is. My guests today are Stephen Kenny, who is the Senior Vice President, Regional Executive for Bank of America, Merrill Lynch, for the New York, New Jersey region. Peter Darcy, the Group Director, Group Head in charge of commercial real estate for M&T Bank. Roy Chin, who is the Regional Executive, New York and New Jersey for TD Bank. And last but never least, Jim Carpenter, the Senior Executive Vice President, Chief Lending Officer for New York Community Bank. Since you've been here and in this seat before, how do you look at the market in the fall of 2010?
We're very encouraged. I would, through 6 months into 2010, we were relatively flat year over year, but this last quarter things have really begun to ramp up. We're seeing strong application growth, closings occurring with much more frequency, and we're very encouraged as we go into.
So how much money do you think you're going to put out this year?
We were on track, I would say a little over $2.6, $2.8 billion year to 2010.
Well, I thought you were a $3.5 billion guy.
$3.5 billion. We closed over $4 or $5 billion in years past. But I mean, in 2009, we closed $2.6 billion. This is just commercial real estate and multifamily, and we're on track to exceed that number this year. But I would say that the last quarter is really where we started to see the momentum begin to swing.
Roy?
2010 has been very much a transition year for TD Bank. Prior to 2009, as you know, TD Bank was basically 3 community banks, $50 billion apiece. With the acquisition, TD USA is today $160 billion. Anchor that with Toronto Dominion in Canada, which is $400 billion. At the top of the house, you're looking at $500, $600 billion. With the consolidation of these larger banks, we have effectively increased our size and allows us to really upmarket in terms of our real estate focus. So 2010 has been very much a transition, moving from what we had done as a community bank, if you will, basically preparing ourselves to enter 2011 in a much more targeted, focused way, very much like the gentleman here on the panel as well.
Peter.
So in 2010, the first half was like 2009 for the most part. We did pre-credit crisis something between $1 and $2 billion a year. That'd be the equivalent of the $3 billion to $4 billion at New York Community. Last year we did $200 million. So even though we were there for our customers, we're hoping to lend, we're hoping to do more, it wasn't there. This year, first half was slow, and second half we have an active pipeline of about $1.5 billion today. So we'll probably close a year out with almost all of it happening in the second half of the year with close to $1 billion.
And you, this small little bank, you know, this regional bank, North Carolina, something like that, you know?
Headquartered in Charlotte.
In Charlotte. So what do you think you guys are going to do?
Well, the market overall, I think, remains fractured. There's still a definite divide line between the haves and the have-nots. And also on the operating platforms as well. There are still legacy issues on people's balance sheets. You know, we all have them. We're all, you know, we've worked through the majority of those over the years, over the last 3 years. As we look forward, you know, 2010 has continued to be a challenge to find new product. We are very much actively trying to get the message out to our clients and to prospective clients that we're open for business, that we have money, that we want to be actively lending in the real estate community. And my hope and my belief is that things have continued to improve. 2009 was, you know, a little bit better than late 2008. 2010 was better than 2009. And while there's still headwinds there, optimistic and across all asset classes with an emphasis on multifamily, that, you know, 2011 will continue to allow us to grow our portfolio.
So since you say you want to put out money, what's the favorite asset class that you want to put money out in?
Well, the easy answer is multifamily, but it's hard to do. You know, on a stabilized asset basis, the insurance companies and the agencies, you know, they price those transactions to a point where it's difficult for us to compete. Where we have been competitive of late, and will look to be competitive as the market here in New York and in northern New Jersey continues to improve, is on new development, construction financing in various marketplaces here in New York and in New Jersey. We have many clients that are actively looking at opportunities to develop various assets. They're still waiting for, I'll say, the tail end of the recessionary market to burn off, which we've seen great signs of, both in New York and in New Jersey. And my expectation is, as that completely burns through the process, there will be people that come and break ground on significant projects in 2011.
Peter, what do you see?
Our business is to try and do a little bit of everything. We're very active now in the development space, just because there's less liquidity there. But we can't only do development, so we need to get our fair share of stabilized deals. So our approach to that is do the development, do the tricky deal, do the private banking type facility for the well-heeled, good operator in the marketplace, and be competitive enough on the stabilized business to try and leverage a good relationship and execution to get stabilized deals. So we're seeing that that's working today. We're just to do an example, there's a client we're doing an 80-20 development for, but he just bought an office building, and we're financing an office building for the same developer. So these were back-to-back transactions.
Yeah, but you know, you bring up, I had 2 weeks ago, I did a show with major office owners, and we were talking about, you know, 2-3 years ago, when you looked at a deal, everybody was looking at projections of future rents. Today, you know, you got to be really more realistic, and you got to look at the tenant. You know, office buildings are, you know, the market has got better, but, you know, it depends where. New Jersey, I wouldn't be jumping for office buildings. New York City, depending on the market, I might. I mean, how do you look at office market?
Office today is, if you look at what's going on in the economy in the city, office is a challenging asset. Rents today, I think when we underwrite office today, we're really underwriting based on rents going in today to be sure they're market rents. I find very few lenders are basically factoring in rent growth. I think rent growth is really an equity risk. But beyond that, I find office in New York to be a really solid asset. You're not going to be, I mean, the financings that we're doing is on going in cash flows. And to the extent there is lease-up risk, lease-up in the building, we typically hold back TI and commissions to cover the lease-up and basically earn out as NOI improves.
Jim, I mean, of the $2.6 billion that you'll be putting out, the majority will be in multifamily. Will you look at new development?
Absolutely. You know, I think our story becomes a little bit boring. You've had me on the show several times, and you asked me, what do we do? And you know, the rent-regulated, rent-stabilized multifamily continues to be our main thrust. It comprises about 70% of our total portfolio, and of the deals that we're doing currently, it's probably closer to 75–80% of the new business that we're doing. We're seeing a very active market, Mike. We're real encouraged directionally with the way volume is flowing. And I think to Roy's point, I think we're in a very disciplined market. Lenders are lending generally smart. There are a few that might be playing a little bit more aggressive, but when we get to the commercial real estate property types, the office and the retail, our coverages are higher, LTVs are lower. We will look at a development deal, but it's only going to be for someone with whom we have had a long history and experience with. Sponsorship is key, but I think for even strong, seasoned sponsorship to come to us for a construction loan that hasn't had a relationship with us in the past, that's going to be a tough hill to climb.
You know, I was saying on a show the week before that the hospitality market in New York has really improved. I mean, even with 100 new hotels, 20,000 new rooms, you know, occupancy today is close to 92% in the city. The average daily rate is up to $280. You know, and it has improved. The only thing is, an office, you have a lease for 5 years, 10 years. In hospitality, you have a lease for one night. Would you entertain a hotel these days?
We have not looked at hotels. You know, fortunately, we're in a very efficient market, and there are a lot of lenders, and everyone has their sweet spots. So I'd love for you guys to look at the stuff we don't look at, and we'll continue to take the multifamily. Hotel, not our cup of tea. And I think one of the the points that was brought out earlier, where's this market going? When you hear that there's construction development money available, which wasn't the case a year and a half ago, I think that's a great indication of this market beginning to show signs of real strength.
But I think what we're saying is there is money available for development, but the development is really in the multifamily development.
Well, we're looking at several hotel transactions, excuse me, as we speak, and one is a development transaction, extremely well located, you have great sponsorship, significant amount of equity, and so, you know, while multifamily is, I'll say, the asset of choice, the difficulty that we all face is there's only so many of those transactions.
So you really don't want that hotel that I spoke to you about on 42nd Street? That other one.
Are you brokering the deal?
No, I'm not brokering the deal. No. But no, I'm trying to create a little edges, you know.
You'll have to remind me of that one later.
Okay.
But there are several that we're looking at. Only one ground up. We're going to be very selective there. But there are, what we have seen as we've gone out and met with a number of developers and/or property owners that have stabilized assets that are looking for debt financing, is that, and acquisition financing as well, is that the flags, including all the major flags, understand that the hospitality market is still a challenge segment to be financed. They're willing to put up their balance sheets in many instances, which with that credit enhancement, it changes the dynamic
deal. Okay, you're dealing with, you know, Hilton or a Hyatt or someone else who says, I'm going to put money in the deal. Right. I'm putting my own pound of flesh over there. There's more commitment in this situation.
We initially only saw it in a very spot basis. We've started to see it in a more expansive basis because, and we've met directly with the flags, and the message that they deliver to us is they see what you see in terms of the statistics: 92% occupancy, room rate growth, and then they look at their proprietary booking systems and say, we're turning all these people away from Manhattan locations. And so they want to add inventory to their books. And so if there's a way with the right developer, with the right equity and the right credit enhancement coming from, you know, an underwritable institution, those are things that we're looking and
So how
exploring.
about retail?
Can I say one thing about hotel?
You can say whatever you want. Come on, interrupt him. I couldn't
A
care.
fascinating thing about hotels today, because of that, there are 20 hotels under construction outside of Manhattan and New York City. So, you know, the Sam Chang phenomena is one thing, but it's really...
And I think the thing Steve didn't say, but he was probably alluding to, is that hotels in Manhattan is different. And when I talk about Manhattan, I talk Manhattan hotels. I don't have the same comfort level talking about a hotel in the Bronx, or 4 more hotels in Long Island City, or, you know, another 3 in downtown Brooklyn.
But they are under construction and
They're
being
under
built.
construction. There's a guy, a friend of mine, who has a Fairfield Inn in Brooklyn. I said, you were supposed to open up in July. He says, the bank who did the loan is controlled by the FDIC. I can't open up the hotel right now.
The important thing is to be able to attract both the tourist and the business segments. So location is paramount.
Retail, which is another paramount situation. How do you like retail? I mean, you guys love retail. I mean, you are the best retail tenant around. Every corner over there, 7 days a week, you see TD over there. You know, these super mega branches.
I like retail. I think, but when you look behind the envelope, what you're really looking at is the credit quality of the tenants in place. There are a lot of great merchandiser out there. You know, New York City is very much thrives on retail, but it's a function of how the company operates its business, the merchandiser, its credit quality, location, and the sponsorship to the project as well.
Jimmy?
I'd have to echo what he's saying. You know, I mean, a lot of the underwriting goes to the tenant base, the credit quality, dispersion of the lease maturities, retail in the city versus retail on the island. We do like, you know, the local strip centers, nice dispersion of.
Yeah, but on a local strip center, would you do it even without an anchored supermarket?
We prefer to see an anchor, obviously, but. Again, I will tell you that when we moved to office retail, LTVs have come down sharply. Three years ago, we may have done a 75% deal. Now we're in the 60, 65% leverage range, and coverages have come up.
Now I'm going to give you something which, you know, and I recently did a restaurant show. Have you, or would you entertain, or is it even in the real estate spectrum, or is it in the middle market spectrum, restaurant financing?
On a standalone basis, I view it as an operating business and would put it in the, you know, commercial spectrum. As part of an overall mixed-use project, you know, you could potentially underwrite a component of restaurant rental, you know, rental income. But we would not want it to be as an operating business. We'd want it to be an arm's length lease, you know, ideally with an operator that has a track record in the marketplace that you're looking at, and with a capital commitment into the project for fit out that's not provided by the landlord but is provided by the tenant.
Peter?
It would be in our middle market or business banking group as well. It's not a easy segment to bank at any institution.
It's a very tough segment. I mean, Capital One's not here today, but you know, when they were Norfolk, they were rather aggressive in that market because their vice chairman happened to be in the restaurant business and he felt comfortable in that marketplace.
There are a handful of super operators in New York that have very good cash flow, very good financial positions, and very good business to banks. I guess with looking at a super operator and a diversified portfolio that had a good liquidity cushion for downturns, maybe we would evaluate it, but in general, probably not.
Roy?
Yeah, same thing. The restaurants, if we were to do them, would be in the middle market area.
Now, you know, I didn't bring up the subject, but if I would have said to you in 2008 or early 2009, I'm looking for a loan on land, you would have said, Michael, do not pass go, do not collect $200, do not talk to me. Today, would you look at a land loan?
Not that likely. If we were to look at a development deal, we'd want to evaluate the
No,
total
I'm not talking about development.
No,
I'm saying, you know,
just
there may be properties, Jim, that can be acquired by someone, and somebody may want to landlock, you know, for future development. Maybe it's not the right time today.
Not something we're chasing right now. If we were to do a land acquisition, it would have to be part of a development scheme that we were financing.
Steve?
The short answer would be no. The longer answer would be we would, like anything else, you'll make exceptions for certain clients. But the key to making that exception is well-heeled, strong track record with that client. You know, for somebody new coming to the bank, the short answer would apply. We wouldn't go beyond that short answer. And then very, very clear understanding of the exit in the very near term. So to land bank somebody that has, you know, future opportunity, is it identifying future opportunities? We would not go there. But if the exit is very clear, very near term, for maybe 3 or 4 named clients, we would say yes.
Well, we're a version of that, but maybe a little looser in regards to we'll do it for someone who is a client who can warrant doing a recourse loan, and we're happy. We like the business, and we're actually doing several deals like that right now, as well as some note finance deals.
Which I want to get to in a second. Roy?
I would echo Stephen and Peter. You know, land at the end of the day is the riskiest part of the cycle, and I think we and many other lenders today really look at the risk profile, and that is an equity. That risk is borne by the equity side.
About a week ago, when I had John Estrich on the show, and we were talking about the funds, we were talking to fund guys, and they were saying that they might back someone on buying a distressed note or a note which is in default. Would you finance somebody's acquisition of note today?
We haven't to date, but it is something that we're actively looking at and talking about with, you know, a handful of clients. I see it as the next opportunity and the big opportunity that's going to present itself.
Because I heard, you know, Signature is out there, they'll do it to a certain point. CapSource will do it to a certain level.
Yeah, the key for me is, you know, as always, you know, it's the price level. You know, what level of discount did they achieve? What level of discount are you achieving behind them? And then I'll say, most importantly, we want to be a bricks and sticks lender. We want to have collateral. And when you're financing notes, you're breaking that rule. So the question is, how quickly, how easily can you get from being the note financer to the property?
In New York City, it could take you 2 to 3 years to go through the fight.
So what mechanism can you build into the structure of that loan that can make you indifferent to that time period? And there's, you know, credit enhancements and you know, and time pressures that may allow you to end up doing some of that business.
Peter, you alluded that you are doing that.
Yeah, we've done a handful, and we're working on 2 additional ones right now, and this would be the pinnacle of the relationship story. So for us, it's not about just having the balance sheet or just having the liquidity. It's about what have you done for us, and do we have that type of relationship?
But here's the question: how much? If somebody bought a note, would you lend them 40%, 50%, 70%? How much of that cost do you think you'd lend them?
It depends on whether we would lend without the note as collateral, and if we think they're money good for an unsecured loan on that type of purchase.
Then you're doing a personal loan based on the collateral, the individual.
But we're doing it both, and then we're probably up to 65% advance rate against the note. And if not, if somebody we still would like to do it for, it could be 50 to call it 65%, and there's recourse on half or all of that, depending on the story, and there's mandatory pay downs and other things if some of the timelines aren't hit.
Roy?
You know, note financing is a specialty unto itself. You really need to get the right operator who has the experience, who understands and has the capital to sustain the additional time it takes to get from point A to point B. We have not done that historically. We are looking at several, pretty much in the 50 to 60% range.
Jim?
I would say with all the opportunities that are out there on the market, with increasing frequency, we've been hit with a number of requests to finance notes. For us, it's all about cash flow. So you know, these are non-cash flowing financing opportunities. The global cash flow of the sponsor really would enter into the equation. It's not something that we'd be eager to look at. We will look at it on an exit if we had a non-performer that we were looking to move, but and we visited this subject on a number of occasions. You know, as Steve said before, I wouldn't rule anything out, but it would have to be the right circumstance.
You know, the general comment that I'm hearing is that you're all in business, much more appetite than a year ago But one thing continues. If you're a novice or limited experience, do not come to my shop. Is that correct?
As a broad statement, I think that that's fair. Bank of America prides itself on client selectivity, and we all have learned the lessons the hard way when you make a mistake about client selectivity over the last several years. So, access to capital, experience, professional staff, and time-tested business acumen are so important to making the financing decision. That said, our collective jobs at our institutions are to continue to kind of unearth the next big player, and I don't know who that's going to be, but that's one of the things that I think a lot about is, can we identify that person? Can we help them grow? And then really take advantage of a full service relationship with that person. Very difficult in this environment, but really what we're all challenged to try to accomplish.
But if we look back, a number of years ago, if we could go even back right after the tragedy of 9/11, banks really stepped away for a period of time. Then the world got a little better, and we got a little too irrational exuberance, and you lend to people, I'm just saying generically, I'm not saying you people, to certain inexperienced. And there were banks who are no longer here. If you remember, we used to have a bank called Chorus, who was a very aggressive lender. There was a Fremont. There were other people because of lending to some inexperienced people of what the market is.
Mike, one of the things that when I look back, I think that we've taken a different view in underwriting when we look at the ownership structure. The lead sponsor, the guy bringing the deal to us, the guy running the job, we've always underwritten. We've paid less attention to the institutional equity money that's behind the investor. And when I look back, I see that the institutional money behaves differently.
I agree.
Not all institutional players react the same way when the cards are against them. Some look in silos. Some may look at a fund may have, or a manager of money may have several different funds.
I wish we had more time to talk, but 30 minutes have gone, and I really think that my audience and I myself have got a good opinion that when I said, oh, show me the money's there. And I'd like to thank Steve Kenny, Peter Darcy, Roy Chin, and Jim Carpenter. See you next week.
Major funding for this program has been provided by grants from Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP. Additional funding has been provided by grants from AVR Realty Company, LLC, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, Cushman & Wakefield, Dime Savings Bank of Williamsburg, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Stephen Napolitano, First American Title Insurance Company, Friedman, LLP, Gemini Real Estate Advisors, LLC, Genova, Burns and Gian Tomasi, Grubb & Ellis, Investors Savings Bank, Jack Joffa & Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Markham, LLP, Marcus and Millichap Real Estate Investment Services, Margolin Weiner and Evans, LLP, Massey Knackle Realty Services, M&T Bank, Meridian Capital Group, The Moynihan Group, Newmark Knight Frank, Orphanides and Associates, Siami Development, Inc., SJP Properties, Sterling and Sterling, Inc., RAL Companies and Affiliates, LLC, Spandrel Property Services, Urban American.